Hello everybody, my name is Nikhil Verma and I welcome you back to Corporate Accounting Lecture Series. In the previous video, we understood how super profit works and what are the different methods of calculating goodwill using the super profits. So today we are going to solve one illustration on the same grounds. So I've given the problem here on the left side in the Word file and we are going to solve it on the Excel sheet as usual. This is the problem which is given here. We are going to split it into two parts. First is our focus will be at calculating super profits. See, I've mentioned here part A and part B. We are going to deal with this problem in two parts. Both the parts will be solved today itself in the same video. However, we are going to focus on the problem looking at these two aspects as separate aspects and not as one. Okay. As in, first we'll focus on finding out super profits. When we arrive at super profits, then we are going to worry about goodwill. Until then, we are not going to even think about goodwill for now. All right. So let me just add it here. Let me just read through the problem. Following is the balance sheet of Suresh Company Limited. The average profits for the last 5 years is rupees 5,375. The market value of land and buildings is 37,500 and that of plant and machinery is 21,250. The normal rate of return is 10%. Balance sheet of Suresh Company Limited as on 31/12/2015. So they've given us the balance sheet. There is share capital, there is reserves and surplus. We have working note for the same. Then we have outside liabilities in the form of long-term borrowings, in the form of trade payables, and in the form of short-term provisions. Then we have the asset side. We have been given tangible fixed assets, intangible fixed assets, which is goodwill. Then we have non-current investments. They have not mentioned what it is, so we will have to consider it. And they have given us current assets. For current assets, they have not given us any working note, which is absolutely fine, no problem, because usually all the current assets are accepted. Yeah, so this is the illustration that is given. They have given us notes to balance sheet. Under share capital, we have equity shares as well as preference shares. We also have a reserve account. Preliminary expenses are also there, and then we have a P&L account. Okay. Then we have tangible fixed assets, land and building, and plant and machinery. We are supposed to calculate goodwill on the basis of 5 years purchase of super profits, sliding scale valuation of super profits, annuity method of valuation of super profits, that is the present value of an equity of ₹1 at 5 years at 10% interest is ₹3.78. So they have given us annuity value as well. And last is capitalization of super profits method. So this is the illustration. Let us begin with the solution. Like I told you, we are going to split it in two parts. Part 1 is super profits and part 2 is goodwill. Now, I have mentioned the formula to calculate super profits here. Super profits is calculated as the difference between average profit and normal profit. Any profit that the company earns over and above the normal profit is considered as super profit. Average profit is already given in the problem. Look at the second sentence. The average profits for the last 5 years is rupees 5,375. So they have directly given us the average profit. So we don't have to bother to calculate average profit. For normal profit, there is another formula. Normal profit is calculated as average capital employed into normal rate of return divided by 100. Normal rate of return is given in the problem at 10%. So the formula will go like average capital employed into 10 divided by 100. Average capital employed is not given. We'll have to calculate it. For that, we have a table drawn here. This will be our step 1. So step number 1 will be calculation of average capital employed. We are going to choose assets side approach for this particular illustration. Okay. You have to choose any one method which you are comfortable with. This I have told it in the previous video too. If you are if you are comfortable with liability side approach, you can choose that. If you are familiar with asset side approach, you can choose that method as well. So first we'll have to take a market value of assets. So let us take all the assets one by one. Let us start with the asset side. We have tangible fixed assets as first. Guys, what do we have to do? Which values do we have to take? Do we have to take the balance sheet values, or we'll have to take the market values? We will have to first focus on market values. If market values are not given, only then we are supposed to look at book values. So the first asset is tangible fixed assets, which is under note number 3. We'll move on to note number 3. Okay, note number 3 is here. Land and building is 32,500 in balance sheet. However, um, in the initial paragraph itself, they have mentioned the market value of land and building. So first, we'll take the market value of land and buildings. What is the market value, guys? It is 37,500. And the next asset is under note number 3. This is the last one, which is plant and machinery. 22,500 in the balance sheet. However, plant and machinery's market value also is provided in the first paragraph. So we'll take that. Plant and machinery is valued at 21,250. Give me just a minute, guys. Okay, so note number 3 is done. Are we done? Let us check. Okay. See this, note number 3, land and building, plant and machinery. That is all. So we are done with note number 3. The next asset that we have is intangible fixed assets. I have told it in the previous video clearly that we are not going to take goodwill and other fictitious assets like fictitious assets, expenses, losses, anything. We are not going to take all of those. For example, preliminary expenses and losses, we are not going to consider them. So even here, we are not going to consider the value of goodwill. We will move on to the next asset, non-current investments. So here you can write investments, or you can write non-current investments. The amount of non-current investments is 8,750 rupees, book value, because market value is not given. The last is current assets. They have given sundry current assets. So we'll just write sundry current assets. That is, they have clubbed and they have given us the amount. So we'll write it that way. If you don't want to write sundry, it's okay. You can only write current assets. This is taken at book value, guys, because market value of these is not given. Now we will have to do the total and write it in the total of A. Write it in the amount column. I'll just do the total. I hope you guys will also get the same amount, which is 71,250 rupees. Now next step is to reduce the outside liabilities from this. Which are the outside liabilities? I have told you all, guys, anything apart from shareholders' funds will be considered as outside liabilities. All right. So we will start from non-current liabilities. Under non-current liabilities, we have 10% debentures. 10% debentures doesn't mean that you take 10%. 10% debentures means debentures are being paid interest at 10% per annum. All right. You have to write it fully, 10% debentures. The next outside liability that we have is sundry creditors. Sundry creditors, the amount is 6,250. There is no market value given. Market value of only land and building and plant and machinery was given. To make it simple for you guys, you can mark it under your notes or the balance sheet for which there are market values that are given. In this case, land and building and plant and machinery had market values given, so you could do some kind of a marking. When you solve, you know that these are the assets or liabilities that for which we have market values given, which will make your life simple. For any asset or liability where there is no marking, you will know that these should be taken at book values as no market value is given. Anyways, we have taken sundry creditors at 6,250, which is book value. The last liability that we have is provision for income tax, which is at 3,750 rupees. This will become our total of B. Let's do the total, guys. The total outside liabilities are 25,000. Now we will find out the total capital employed. The total capital employed will be total of A minus B, total of A minus total of B, which is nothing but 71,250 minus 25,000. We get 46,250 as our capital employed. Now we are supposed to find out average capital employed. In order to find out average capital employed, we have to reduce half of current year's profit from capital employed. So what is the current year profit, guys? The current year profit is given in the notes to balance sheet under reserves and surplus. See here, P&L account, current year. And since the amount is positive, that means it is surplus, which is nothing but profit. So current half of current year profit. The current year profit is 5,000. We have to do half of it, which will be how much? 2,500, guys. Now we will get average capital employed. We will get average capital employed by subtracting the capital employed with half of current year's profit. So the average capital employed is 43,750. I hope you guys have understood this. Guys, some of you might have a doubt as to why we have considered non-current investments. We have because in the previous video I told you guys that investments made in government securities and all will not be accepted. We are accepting this as it is nowhere mentioned that these investments are made in government securities, and we are considering these as trading investments. We are not considering them as non-trading investments. That is why we have considered them. So until and unless specifically mentioned that these are non-trading investments or they are investments made in government securities, we will accept them. All right. Now that we have found out average capital employed, we will substitute this value in the formula of normal profit. We are supposed to find out normal profit, right? See here. In order to find out normal profit, we needed average capital employed. That is why we have found out average capital employed. Now we will substitute the values. 43,750 into normal rate of return is how much, guys? 10% divided by 100. So let us find out how much that will be. 43,750 into 10 divided by 100. We get 4,375. So we have found out our normal profit. Our normal profit is 4,375 rupees, which will now help us find out the super profit. Super profit is nothing but average profit minus normal profit. See this, I have mentioned the formula here. Super profit is equals to average profit minus normal profit. How much is our average profit? Average profit is given in the problem. See here, the average profits for the last 5 years is rupees 5,375. 5,375 minus the normal profit 4,375. So let's find out 5,375 minus 4,375. So our super profit is 1,000 rupees. All right. These are all fictitious value, guys. I hope you understand and don't get confused saying, "Arey, company ka 1,000 rupees profit is." No. These are all fictitious values that we have taken for your understanding. Now that we have found out super profit, part A of the problem is over. This is the most critical aspect, finding out super profit. If you get the super profit correct, you will be able to find out the right value of goodwill on the basis of each of the methods that are given. Now we are supposed to find out goodwill on the basis of super profits on these 4 techniques that are mentioned here. First technique that they have given is 5 years purchase of super profit. See, I have taken the next step as valuation of goodwill. First one, 5 years purchase of super profit. So super profit is 1000 rupees into number of years purchased. It is 5 years purchased. So let us find it out. 1000 into 5, which is 5000 rupees. So goodwill on the basis of purchase of super profits is 5000 rupees. Now we have a sliding scale method. Under sliding scale method, it is based on number of years purchased. In this case also it is 5 years purchase. So for sliding scale also we will take 5 years purchase. However, we have to first divide the super profits into 5 parts. So super profit is 1000. Super profit is 1000 rupees. Now we have to divide it by 5. That will come up to 200 rupees. So now that 200 will be entered in all 5 years. We have to make equal parts depending on number of years purchased. Goodwill is 5 years purchase of super profit. So we are making 5 divisions. 5 divisions, okay. So 200 each will make it 1000 rupees. We have taken those divisions. Now we will multiply them on the basis of scaling, and we are going to do the grading scale on the basis of diminishing values. We assume that if a company is making super profits, they will not be able to make super profits for a long period of time. They might be making super profits because of some peculiar value which they offer to the customers. And there is a belief that under this technique there is a belief that you will not be able to give that same special feeling for a long term to the customers, and the feeling that you gave to the customers, the special feeling that you gave to the customers is going to reduce as the time proceeds, and that is why the value of super profits is going to reduce each year, is what this technique tells us. See, that is why the value of goodwill in the first part will be 1000. As we go down the years, the profits have been reducing, the value of goodwill has been reducing. So the total value of goodwill will be sum of all the years, which will be 3000. So according to this technique, the value of goodwill is 3000. Okay. Moving on to the third technique, which is annuity method of valuation of super profits. In the question itself, they have given us the annuity value. Annuity value of rupee 1 at 10% for 5 years is 3.78. See, the normal rate of return is 10%. So at 10%, the annuity value of 1 rupee for 5 years is 3.78. How do we calculate goodwill? The goodwill under this technique will be calculated by taking the super profits, which is 1000 rupees, into multiplying it with the annuity value, which is 3.78. Let us try to find that out. 1000 into 3.78. So that will be 3780 rupees. Under this technique, under annuity method, the value of goodwill will be 3780 rupees. The last technique that we have is capitalization of super profit. The formula for capitalization of super profits is super profit into 100 divided by NRR. So we'll take the super profits, which is 1000 rupees, into 100 divided by normal rate of return, which is 10%, guys. So 100 divided by 10. Let us do the calculation here. 1000 into 100 divided by NRR, which is 10. We get 10,000 rupees as the value of goodwill. If you see, under each technique, the value of goodwill has been different. Under the first technique, the value of goodwill is 5,000. Under a sliding scale method, it is 3,000. Under annuity method, it is 3,780. and under capitalization of super profits it is 10,000. That is how you will write your conclusion. Valuation of goodwill on the basis of these 4 years are 4 techniques are as follows, and you'll write each of the technique: A, purchase of super profits; B, sliding scale; C, annuity method; and D, capitalization of super profits. And write the value of goodwills that you have got there, so that the evaluator gets a clear picture as to what are your values. All right. Um, Depending on what is the purpose of calculating goodwill, you are going to adopt that technique that suits you the best. You have to identify which is that method of goodwill that is going to suit your purpose the best, and using that method you are going to find out the value of goodwill. Like I told you in the initial stages, that there is no fixed method of calculating goodwill. There are variety of methods. Apart from this, companies might come up with their own valuation depending on their perception of what they feel their goodwill value is in the market. Um, so we are going to solve one more problem probably in the next lecture, and try to get a hang of this method of calculating goodwill, because this method is asked for 15 marks. This has been asked most often, uh, usually asked sometimes in case studies as well. But it is a sure shot question for 15 marks. That is valuation of goodwill using super profits. I hope you guys have understood the illustration, and I hope you will practice it in your house. Thank you.